worries about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Season continues.
There's so much nervousness in the market right now.
This market punches you in the face.
Bloomberg is fastest with the numbers and analysis.
Big numbers from Disney.
It just slammed expectations.
Bloomberg, the fastest numbers and analysis you trust.
I thought the Fed's posture at last was broadly appropriate, and now the question's going to involve carrying through. But I do continue to believe that a soft landing is an unlikely outcome.
That was Larry Summers, the former US Treasury Secretary, coming very close to a compliment for the Federal Reserve just then, Tom, saying at last broadly appropriate the stance, and then finishing by saying, well, a soft landing is an unlikely outcome for this Federal Reserve.
He's hit the ball out of the park on the inflation dynamic, and I'm going to give him some credit on GDP because nominal GDP masks a stagflation, John, for a large part of the audience. Real GDP is under 4%. That's still elevated, I get it. Yep. But for a huge part of America, we're getting staggy quicker than maybe we thought.
I'll whip through things quickly, Tom. Futures down 0.4 on the S&P, just a bit softer this morning, and good morning to you all. On the Nasdaq, we're down by not even 0.1%. Yields are higher, though, as we reopen and get back to work on Wall Street. Yields higher by 7 basis points on a Treasury to about 281. Governor Waller responsible for some of that. And then, Tom, just that sneaky move. We keep going back to it, TK. 118.26, crude up by almost 3%.
It will be interesting to say the least. We're going to do what we do on Surveillance Best, which is digress here. Joe Matthew and I are trying to get the Red Sox above 500. Maria Tadeo hasn't slept in 5 days off of the stunning win of Real Madrid against Liverpool. And then there was a problem. There were terrible protests in Paris. John Farrow, help me out here. I'm not up to speed on this, but Maria, as a first question with John's expertise, this is another example of the fragility of EU confidence when you can't even get protest in Paris correct.
I'm not sure if I agree. I think what that shows is that Real Madrid is the best team in the world and got vindicated on every front. As a team, won the Champions League. As a city, it was just better organized. I'm not sure it comes down to the functioning of the European Union, but more the greatness of what is the best team in the world.
I had a feeling you would go there, Maria. I had a feeling you would go there. You've had your moment.
Did she get the script?
TK,
I mean, did she get the script?
What happened was this final got taken off Russia and was given to France, to Paris. And Maria, the policing of this final, according to many people who were there, many people who have experienced it, was absolutely terrible. What went wrong and how big a story is this in Europe now?
Look, Look, I think right now, if you step away from the world of finance, and I know for us it's very difficult, but if you step down into what people talk about at the restaurant and the bar and when they have a drink, it is probably the biggest story right now in Europe. I mean, it's Champions League. This is the biggest match that we have other than the World Cup. It is two big teams. It's, of course, Real Madrid coming off that saga of Mbappé not joining the team, but nonetheless winning again for the 14th time in history. No one has ever done that, just as a matter of fact, for the record. But I think it also shows that this was just a terrible, terrible organization. It was a big failure. And what you see here, however, and this goes back to some of the politics here, is that the French, they blame, of course, the English fans, saying a lot of this was bad behavior. The English fans who paid for a ticket and who were there, they say it was bad policing. And when you talk to the Real Madrid fans, they say, well, we don't care because we won the cup. I mean...
Yeah, Lisa, have you ever seen Maria more engaged? I don't believe I have.
Well, she was pretty engaged when she was telling you how to pronounce Javier's last name. I do want to, though, just dovetail this, Maria, this sense of how we look at what people are talking about in bars and restaurants. And it is this feeling of discontent, perhaps not just this match, but also more broadly, of the higher gas prices, the higher utility bills, the incredible inflation surge that's a record over in Europe. How much is that eroding the willingness to have a ban on oil and gas from Russia, from taking a hard line and looking to the quality of life at home?
Yeah, I think we're now at a point in which this war is, of course, affecting the consumer. We see it on the inflation print. We saw it today. There's been this agreement on this oil ban, which I would say on a serious note is actually pretty significant. The Europeans say that if everyone plays by the rules and they do what they say they will do, by the end of the year, you're looking at a 90% reduction of Russian oil exports into the European Union. So that is pretty significant on the detail, but it does bring up a good question, which is what happens next? How many sanctions? What else can the European Union do? And the big question is gas. And I spoke to the Belgian Prime Minister right here, and I put that question to him. Are we now going into gas? And he told me, for the time being, we need to take a breather. I think when it comes to energy, we've reached the limits of what we can do on the short term, because we need to really assess the second round effects of all of this.
Joe Matthew, no one in America cares about Real Madrid and Liverpool, but we do care about the next step of the White House on Ukraine. What is the next step given the action in Brussels?
The next step is apparently to take a step back here, Tom. There was talk about these long-range missiles that President Zelensky has been asking for weeks. And just yesterday, even amid reporting over the weekend that the U.S. was putting together a new weapons package, the president was adamant to say that we're not going to be sending those missiles, known as MLRS, multiple launch rocket systems. This would allow, in terms at least regarding this standoff in the Donetsk, the president says would allow Ukraine to lob missiles into Russia. That draws the line between what's considered defensive and offensive weaponry. This is a new line that we're drawing here, much like we did with the MiG-29s. And interesting, as they go back to the drawing board here to see what weapons we can send Ukraine, we're now starting to eliminate some of them here in Washington.
Hey, Joe, looking forward to the show a little bit later. Sound On, weekdays at 5 p.m., Monday to Friday with Joe Matthew. Looking forward to that. Did Maria ever tell you the story, Tom, about how Real Madrid were the greatest team in the world?
No, I think I missed that.
Do you want to tune in again for that a little bit later? Joe Matthew's going to have Maria Tadeo on for a full 30 minutes.
Oh, very cool.
On Bloomberg Radio to talk about how Real Madrid is the greatest team.
I'll have to brush up on that.
TK, you should have known better. Once you bring up Real Madrid and Maria.
She just looked like, boom. I mean, she's just like that. Should they bring Gareth back to the tots? I mean,
you'd like to see that happen, wouldn't you?
He kicks the ball from far out. He's exciting.
Isn't that your bottom line for everything?
Yeah, it is.
That's basically the threshold. Bramo, this is how TK establishes whether someone is a good or bad footballer, whether they kick the ball from far out or not.
Well,
that's the extent of the analysis.
His football analysis also
is he too old, John?
This is
Seriously.
where they use their foot, not their hand, to throw the football,
because
we're talking about a different
actually, bottom line, he's a
football.
tremendous golfer and spends a lot of time playing golf, Tom, and I wonder whether in the not too distant future he thinks about doing that full time.
Okay.
In his own time, not to become a professional, but just to do that instead of playing football.
Oh, a message from Al from New Jersey.
What's
Can
Al
you do
say?
any more soccer?
I think we're done. I think we're done. Bloomberg style, Tom, is football now, not soccer. You know that. You know that.
Yes.
It is. It's in the rule book. Futures this morning, and good morning. We're down about 0.5%. For those of you who like football, you've missed me, and if you don't, you probably haven't. I apologise for that. Yields are higher by 7 or 8 basis points on a 10-year to 281.33.
Quote a gallon of gas in Capri.
Ton of economic data coming out through the week. I imagine it's pretty expensive.
It's $7. It's like.
Do you actually know that for a fact? Do you making that up?
Yeah, but you had the Renault.
Not in dollars.
Have you just made a number up?
In Capri.
No,
It just
Capri.
made it,
A
okay.
gallon of gas in Capri is $7.69.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Live from New York City this morning. Good morning to you all on TV and radio. Here is your price action. Down about 0.5% on the S&P. On the NASDAQ, down about 0.1%. Last week, snapping 7 straight weeks of losses on the S&P. It does not take much of a spark to start a fire in a market that hasn't seen gains in about 2 months. And last week, all it really took was one Fed official to come out and say, maybe we could have a pause later this summer. Some of the data might validate that. Maybe you saw some of that in the minutes, confirming your priors for the Federal Reserve minutes last week. Well, Governor Waller yesterday gave that one a bit of a backhand. And this is what Treasury yields look like this morning. 2s, 10s and 30s yields up across the board through the curve. 2s, 10s and 30s yields higher by 7 basis points on a 10-year to 281, on a 2-year by 5 or 6 basis points to 253. Tom mentioned the data, tons of it. You get JOLTS, the ISM, payrolls later this week, all of that good stuff. Throw in China reopening. That's an important data point, and push that through this commodity market. WTI and Brent, I think it was Mr. Hartnett over at Bank of America called this one a sneaky rally, Tom. It continues. WTI up by more than 3%, 118, and let's round it up to 80.
The persistency there is valid, but also I'm going to look at renminbi, John. You had a stronger renminbi all in all, 6.66 yuan. So there is a little bit of movement to watch in EM, and particularly off renminbi about the China reopening.
Bramo, that demand just giving this commodity market a bit more of a kick.
Yeah, and frankly, we don't know how long it's going to last or how robust it will be, but it just adds to already this feeling that the only reason why oil prices haven't been even higher is simply because there has been less liquidity in markets, and so people haven't been able to put as much down on options and futures trading, which is really remarkable to me.
Brent crude right now, 123. That's the cross-asset price action. Let's get you some single names, some movers this morning. Let's say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Well, here in the month of May, 7 of the top 10 stocks in the S&P 500 are energy stocks, and that's kind of the story this morning, looking at Brent crude above 124 at one point here on the day, and WTI above 113. ExxonMobil up about 1% on the day. Occidental Petroleum, best performer in the S&P on a year-to-date basis, higher by about 3% here in the pre-market, as a lot of people now start to look at that churn, not only with regards to crude oil, but of course with some of those refined products and the persistent price increases that we're seeing there. And of course, what's good for an Exxon and an Oxy, not necessarily good for the travel space. American Airlines shares down about 1.3% here in the pre-market, as are most of the other airlines, despite an attempt last week to stage a little bit of a rally, a 3-day rally there. We should point out American Airlines going to end the month down here, barring some sort of big reversal here later in the day. You flip it up and take a look at what's going on over in China. You mentioned that, Tom, with the John, excuse me, with the reopenings there. JD up about 6% here on the day. Alibaba and the rest of the Chinese ADRs also getting a bit of a bid. And keep an eye on some of the U.S. companies that have a big exposure into China, like Tesla and Apple, also getting the bid here as well. Movie theater stocks higher here this morning, with AMC Entertainment up about 7% on the back of that really good showing of the new Tom Cruise reboot of Top Gun. $124 million at the box office just in the U.S. and Canada alone. That was the biggest theatrical release that we've seen so far on a monetary basis since the pandemic. And after the bell tonight, Tom, we're going to get some more earnings, believe it or not. Salesforce coming out after the bell. Those shares slightly higher here in the pre-market.
Romain Bostic, thank you so much. To close this afternoon. Right now, we want to jump to Laura Ram. She's Chief U.S. Economist at FS Investments. I think we've talked a fair amount about the meeting to be held today. Laura, let me go to the makeup of inflation. What is different about this inflation versus the inflation of previous times?
So this inflation is really coming from everywhere. And I think it is so important to stress the food and energy component of this, because we're used to seeing volatility at the gas pump, but the just really ominous continued climb of food prices has given this combined basket inflation of over 17%. And while the overall inflation, CPI did likely peak in March, but food and energy is still climbing, and it is so punitive. It is punitive. Every household in America needs to buy these two things, and it really is making the Fed look more disconnected. Their focus on core inflation looks like it's way behind the curve.
Right. So, Laura, we showed earlier the famous photograph of Alan Greenspan laying on the floor because of his bad back. So you're in the Oval Office today, and they're doing couch time. Yellen, Powell, the president, and Laura Ram is laying on the floor with her bad back. Laura, what do you tell them about the when of inflation coming down if they just do a prescribed Fed policy?
So, what I would tell them is they need to front load these rate hikes as much as possible, because we know that there's only so much they're going to be able to impact some of the supply chain disruption factors that we've had, energy prices, given that there's such a, again, geopolitical component to that. I would tell them to front load and then take a very data dependent approach come September, come December. The reality is, I don't think they're going to be able to raise as much as markets have priced in.
Laura, why are we not seeing consumers pull back at all? Why are we seeing spending continuing to be so robust, despite some of the sentiment reads that have been negative?
You know, we'll get the other consumer confidence data later today. I do think that you're having this tug and pull between households that are badly concerned about inflation, but are still supported by a healthy job market. That said, the components of spending are clearly shifting. I think we have less spending on durable goods going forward, less spending on non-durable goods. There is going to be a focus on services over the summer. I think it's the back half of the year that gets very uncertain. And that's where I'm concerned that people are going to have their summer vacation. They've been waiting for it. And the kids are clamoring to go to Disney World. But come the fall, with food and energy prices still sticky and high, people really at that point change into savings mode and try to rebuild that savings.
So it has to do with the labor market. We get the latest read on the labor market this Friday. 2021 was notable for revisions, for the upward revisions that changed everybody's view dramatically of a labor market that looked from like it was decelerating to one that seemed like it was red hot all through the summer. What kind of revisions can we expect? What do we see in some of the second and third reads of what we've seen so far this year?
You know, the data collection, I think, is still problematic during COVID. So revisions have been larger. I think it's just important to remember that the employment data are already a lagging indicator of the business cycle. I think we get another strong data, I think we get another strong employment report. It just takes Fed rate hikes quarters to impact the economy. And we often don't see the unemployment rate keeps climbing well after the Fed has stopped raising rates, long after it stopped trying to slow the economy down. So I think we get another strong payroll report. My canary in the coal mine is always initial claims, which have stayed very low. If that starts backing up, we get a 5%, 10% increase in claims. To me, that would be a really hard sign that company behavior around employees has changed radically. But, we have been resilient in this job market, wave after wave of COVID, depending on what's hitting us. Employers are holding on to their bodies.
Laura, I got to go back to first principles. Laura, China reopens. What does the dollar do?
I think the dollar continues to strengthen across the majors, Tom, but I think it can stay strong against the yuan. I think that the exchange rate is going to be one of the last things that the Chinese authorities do to try to right-size the fact that they need to continue to stimulate the economy. I actually think we could see more dollar strength against the Southeast Asian complex and against the renminbi.
Laura, thank you. Laura Rain there of FS Investments on an FX market that I think the next stop for this one, Lisa, away from payrolls and the US data, it's got to be the ECB next week, and President Lagarde, after speaking to Francine Lacqua last week in Davos, really teeing up this ECB to do something it has not done for a long, long time, and that's raise interest rates.
9 days away, I think that this ECB meeting is actually going to be one of the most pivotal in its history, especially in light of record inflation and in light of some of the disagreements that you're hearing from ECB officials, not about whether to raise rates, but by how much and whether a 50 basis point rate hike is on the table.
Have we established whether that is euro negative or euro positive?
No. Absolutely not.
Still totally divided on that issue.
Unclear what that actually means at a time when it really has to do with the momentum in the economy just as much as rate positioning. And frankly, the ECB is going to remain behind what the Federal Reserve does. It's just about whether it raises rates to support the economy and create some sort of ceiling for inflation, or whether it actually dampens growth in a material way that's going to be harmful.
And that's a complex one, Tom. With this economic backdrop for this ECB to raise interest rates, what does it mean for this currency? Positive or negative?
I don't have a clue, because you've got to fold in the war. I think the war over the weekend, John, this has been underreported, was absolutely brutal. There were drone images somewhere out in the zeitgeist that looked like something out of World War I. I think the news flow is so extraordinary that Lagarde just has to get to the meeting.
Policymakers in a tough spot around the world, Tom. In about 3 minutes' time, let's call it 5 or 6, Brian Deese, the National Economic Council Director, joining us on this show just 5 minutes away, Tom. Big conversation still ahead.
He's going to talk to lots of the media today, but we need to ask him, John, pointed questions about the history of the Fed sitting in the Oval Office and what the president's going to do about Fed independence. We know for certain President Trump would approach this differently.
A difficult one in many ways, Lisa, and how many times have we said that so far this morning? The optics of this, what do you make of the optics of this meeting later this afternoon between the president, Chair Powell, and Secretary Yellen?
how much is this going to be a blame game? I don't think this is going to be kumbaya. This is going to be President Biden saying to the Fed, get on this. This is your job. This is what you need to do to control this. How much does it actually put pressure on Fed Chair Jay Powell to go more aggressively or, frankly, to show his independence? Because right now there's a credibility issue on both sides, getting inflation under control as well as being independent from the political bodies.
Are you suggesting still the Fed pivot wasn't down to the ECI data and it was down to the chairman getting a second term?
I wasn't going there, but I'm sure that you'd like to go there.
I love to go there. I love to go there. Unfortunately,
know.
Chairman Powell won't sit down with me and have that conversation.
I don't
Wouldn't that be nice,
agree
Tom?
with any of that.
Just you don't agree with it? You think it was the ECI data point?
I think the Fed is going to do what the Fed does, and the president knows it. This is a president that has a very clear history of LBJ and McChesney Martin, Bill Martin in the middle 1960s. But John, it's okay. Lisa and I didn't agree on Velveeta cheese fondue in Davos either.
I imagine I would take the other side of that one too,
Tom.
I'd be firmly on Team Bramo on that issue.
Just a log of Velveeta melting.
It sounds disgusting.
Gorgeous.
Brian Deese is going to be joining us, the National Economic Council Director from the White House, 5 minutes away from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. European Union leaders have agreed to back a partial ban on Russian oil. It would be part of a sixth package of sanctions aimed at punishing Russia for invading Ukraine. The sanctions would ban the purchase of Russian oil and petroleum products delivered by ships, but it temporarily allows EU nations to buy Russian oil delivered by pipeline. That exemption is needed to get Hungary to sign on. Inflation in the Eurozone accelerated to an all-time high this month. Consumer prices rose more than expected, 8.1% from a year ago. Food and energy were the big reasons. The data will intensify the debate at the European Central Bank about how fast to raise interest rates. And President Biden says there are limits to what he can do about guns. Over the weekend, the president visited the Texas elementary school where 19 children and 2 teachers were killed. He has renewed calls for Congress to crack down on the kinds of assault weapons that were used to carry out the killings. PIMCO will be one of the biggest players in this week's drama over whether Russia's credit default swaps will pay out. The firm's largest fund increased its exposure to Russian swaps to more than $1 billion in the run-up to the invasion of Ukraine. PIMCO is part of a panel of dealers and investors that meets today to decide whether the swaps should be triggered. GSK has agreed to buy vaccine maker Affinivax, for as much as $3.3 billion. The British pharmaceutical company is buying up next-generation vaccines while it prepares to split with its consumer health unit. Last month, GSK announced a takeover of Sierra Oncology, a maker of targeted therapies for rare forms of cancer. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think the time has passed for a soft landing. We could have done it, but that would have implied the Fed moving 9 months ago. It should have, it didn't.
That was Mohammed Al-Arian there weighing in on the situation with the Federal Reserve. Chairman Powell a little bit later this afternoon, TK, with the President of the United States and Secretary Yellen as well. An important meeting taking place a little bit later today.
Something we haven't mentioned here, John, the real yield, the 10-year real yield comes down over the last week, 0.12%, showing some of the interesting dynamics within the markets. The dynamic of the morning will be the Oval Office with the chairman of the Federal Reserve System and his president, joined by the Secretary of Treasury, of course, the former chair of the Fed, Janet Yellen. Powell, Yellen, and Biden. Brian Deese joins, director of the National Economic Council, who will be in charge of niceties and pouring tea at the meeting. Brian, the singular distinction here is Yellen codified the word slack of an America unemployed. That is not the case now. Powell's Fed is roughly a fully employed America. How will the president listen to these two about jobs in America in this horrific inflation?
Well, he'll listen to them and he'll underscore his core point, which is that he intends to provide the Fed with the space and the independence that it needs to operate. As you all know, he has nominated a quality slate of people, including at the top of that slate, Chair Powell, to lead the Federal Reserve through this challenging time, and he intends to give them the space to operate. But we are in an environment, a unique environment, and we have unique economic strengths right now, the job market and the labor market being chief among them, but not the only one. Household balance sheets are in a very strong position because over the course of this recovery, Americans have been able to save more and pay down debt. We're seeing business creation, small business creation up at record levels. So we have unique economic strengths which position us well now to focus on this challenge, which is bringing prices down. Obviously, the Federal Reserve plays a primary role in that, but fiscal policy and the economic choices that we make with Congress play an important role as well. All of that will be on the table today.
Brian, let's talk about that meeting today and whether it's anything more than a photo op, given that you've said you don't want to comment on Fed policy, the Fed doesn't want to comment on fiscal policy. What is the purpose of today if it's not just a photo op? What do you discuss? What comes out of it? How does it help Americans? And you've seen the polls yourself. 65% of adults say their family's income is falling behind the cost of living. So a lot of people looking at this, it feels just like a photo op. For Americans struggling right now, they want more than just that. Is it more than that?
Absolutely. A couple things. The first is it's standard practice for presidents and chairs of the Federal Reserve to meet from time to time to share views on the economy. In this case, secondly, the president is underscoring something important. The respect for the independence of the Fed as an institution is not something that we can take for granted. It's not something that prior presidents have done to re-underwrite that independence. And so doing so, having the president do so in a public way and underscore that he is committed to making sure that the Federal Reserve as an independent institution can operate is incredibly important at this moment. And it's not just about a photo op, it's about sending that signal clearly to the public. And number three, they have a president, the American people, those who are feeling anxious, and absolutely understand that when people go to the gas pump or to the grocery store, they are feeling anxious. They have a president who is waking up in the morning and focused on how to address that challenge. And one of the things he can do is, in his position, underscore the independence of the Federal Reserve. So I think for all of those reasons, this is an important step in the process, not the only step, and we are going to remain focused, and over the course of the next week and the week after that, we'll focus on the steps that we can take to help try to address price increases as well.
One thing under discussion, and we know this from several reports, and we've talked about this previously, Brian, is student debt relief. The White House considering something up to $10,000. There are people without a college degree wondering why those with a college degree are getting this help. I'll go through the numbers and then I'll ask for your response. So the latest research from Pew points out that 4 in 10 Americans aged 25 or older have a bachelor's degree or higher. Among that, as you know, for Black American adults, for Hispanic adults, that number is much, much lower than 4 in 10. You also know there's a growing earnings gap between those who have a college degree and those who do not. The unemployment rate is lower for those that have a college degree compared to those who do not. So the question, Brian, that people are asking if they don't have a college degree right now is, who is that to help? Who are you doing that for? Why are you considering doing that? Who's it for, other than just energizing the base going into the midterms later this year?
Well, first, we should be trying to help everybody who wants to work get into a job that will give them pay and an upward mobility and opportunity to succeed. And one of the things we're seeing about having such a strong labor market recovery right now is we're seeing historic gains, not just overall, the largest decline in the unemployment rate in any recovery in recent history, but also record gains for blacks, record reduction in the unemployment rate. Hispanics, the largest reduction in the unemployment rate for Hispanics ever on record. So we're seeing that in the job market. We want to do more. A lot of that is about workplace training,
well, Brian, excuse me to jump in. I just want to nail down the point because you know this is important. As you know, and I'll repeat it, those with a college degree seem to be doing much, much better than those without. As you work out relief for the American people at the moment, why is there focus on $10,000 of student debt relief at a time when those people in America who do not have a college degree are getting squeezed by gas prices, crude again this morning at 118, JP Morgan saying gas could hit $6 later this year? You know the people that's hitting the most. Many of those do not have a college degree. Why is this administration focused on doing something which, let's face it, might play well in the midterms, but ultimately isn't going to help those people that need the help the most right now?
Yeah, my point is we're focused on trying to help everybody, but to the question of those, and a lot of the steps that we are taking are going to help people who have less than a college degree. But when you look at the issue of student debt, there are tens of millions of Americans out there who are in the labor market and now may have gotten some college education or a college education, but are held back by the burden of having to pay, in some cases, extraordinarily high debt. So the question there is are there steps that we can take, prudent steps that we can take to try to help unlock economic opportunities for those families, while at the same time doing everything we can to help create a labor market that is creating dynamics like the one we're seeing now, where for the first time in a very long time, people without a college degree, people with some college degree are seeing economic opportunities to move into jobs with higher wages that they haven't in some time. We're also focused on trying to sustain that and continue that going forward.
Brian, good to catch up, as always. Always fantastic to get your perspective on things. Brian Deese there of the National Economic Council. Tough moment for this White House, Lisa. For many people, they hope that it's more than just a photo op later this afternoon, because the polls for this president aren't promising for this administration.
It's a very difficult issue because there's so many different features that are playing into inflation, and there is such a bifurcated nature to the pain being felt by households that have college degrees and households that have higher incomes and those that do not. How do you sort of parse that out and speak to everyone when everyone's facing a very different reality?
Tom, why the focus on the $10,000? We tried to nail that down. Why the focus on student debt relief?
Oh, I don't. John, to me, it's a side story. To me, the major issue here is investment, spurring investment spending, and spurring trade, as the president did when he went to North Asia. I just think the investment lift is the only way out of this mess.
Futures down about 0.5% on the S&P, on the Nasdaq down by around about 0.1%. A little bit later this afternoon, the President of the United States sitting down with the Chairman of the Federal Reserve. From New York, this is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
three major areas of the global economy are slowing at the same time.
What the market has told us over the last 3 months really is they think the Fed has got this.
You want to be in this market, but you want to be managing your risks. That's the key here.
It's not just a bond bear market you're talking about, we're talking about a stock bear market.
This is not a time when you try to chase and call a bottom, call a peak, call an inflection point, because honestly, inflection points are happening daily.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. We welcome all of you back to our studios in New York. And John, the singular story this morning is oil, American oil, 119 a barrel. We saw a 122 print on Brent.
Driving season begins, Tom, and it begins with gas prices approaching $5 on average across this country. Some places higher, some places lower. But TK, the direction is pretty clear. We mentioned some of the research from JP Morgan. It could hit $6 later this year. There's a problem, Tom, in the economy for a lot of those people experiencing that in a bigger way, and there's a problem in this White House too on how to address it.
This week on economic data gets us to the mid-year outlook. You wonder what the mid-year outlook is, John, for the President of the United States as he sits down with the Secretary of Treasury and the Chairman of the Federal Reserve.
And approaching, Tom, a mid-year outlook for this Federal Reserve as well. Last week it was President Bostic teeing up a pause maybe later this summer. Yesterday afternoon it was Governor Wallace saying, no thank you, we've got a lot of work to do.
Well, we've got a lot of work to do. John, I'm going to go back to the idea of the many uncertainties that are out there, and downplayed here over the weekend was a China reopening. Just the headline that flew by 20 minutes ago of Beijing schools opening in June.
And push that through the commodity market. The trend is clear, Tom. Yeah. You were waiting for it. Crude higher, Brent, WTI back through 120 on Brent. Tom, I give the policymakers a lot of grief, but let's face it, if you're a policymaker, if you're a member of a C-suite, a corporation in the leadership, an investor right now, gauging where this economy is and where it's going is tremendously difficult to do because it's moving so quickly.
Lisa, the 8% inflation statistics in Europe today, Italy, Japan, Germany rather, and the rest comes down to the inflation meeting this, this afternoon, 1 p.m. With the president. What are they going to talk about?
Honestly, and what does it matter? I mean, we were talking about that with Brian Deese, right? I mean, we were asking, what's the point of this meeting if you're trying to reaffirm the independence of the Fed? What are they going for here other than a photo op? Honestly, how do you address it when you keep getting buffeted by new events? And I think about the China reopening that you talk about, Tom.
Well,
how much does this have legs, right? I mean, if they continue to soften a zero COVID stance, how much do we see that sort of upward trajectory go well beyond what people are expecting with oil and gas?
Our guests to a person say the only way to address it, Lisa, is to raise rates. We assume that in June, right?
Look, how is that going to solve the oil and gas problems, right? That's not going to solve the oil and gas problems. Maybe it'll reduce demand, but you're not really seeing that. There still has been an increase year over year in spending, even on an inflation-adjusted basis, even with real wages deeply negative. At what point do you start to see the slowdown in demand and some of the pushback from consumers to the higher prices?
John, I hereby dub June, and I'm going to go back to FDR in the heart of the Depression. As I paraphrase, FDR said, do something. It's do something June.
June 15th, the Fed will do something. Most likely hike rates 50 basis points. They'll go again in late July, Tom. Most likely 50 basis points. And then there's a big gap between then into September with Jackson Hole in between. And that's why there's space, a little bit of vacuum, if you will, Tom, that people are filling with this idea that that's when you get a pause from this Fed into September and beyond.
Brent crude 123.69, West Texas 118.70. What else do you see, John?
Equities down just a little bit, softer by 0.6%. I have to say, if you asked me to guess yesterday after seeing those words from Governor Waller, I'd expect us to be down a whole lot more. We're not. Futures on the NASDAQ down about 0.2%. You are seeing that move in yields, though, up by 8 basis points on a 10-year to 282. Not all of that is Governor Waller, the Fed, and U.S. It's all about Europe, too. Upside surprise, Tom, after upside surprise on inflation reads in Europe. Euro-dollar 107.07, negative 0.7 on that currency pair.
Critically, the real yield coming down. It's still positive 0.12%. Something to watch during the week. And someone always watching that is Peter Cherry. He's head of macro strategy at Academy Securities, traveling this nation for Academy Securities, and someone who does a beautiful synthesis across equities, bonds, currencies, and commodities. Peter, what's it like out there? You've been on the plane, you've been in the hotels. I know you stay exclusively at fancy places like the St. Regis, the Four Seasons, and the rest. What are you hearing out there?
Well, none of that's in our budget. But anyways,
I think there's this frustration with where policy is headed. I think, as Lisa said earlier, are we addressing the right thing, right? I think we're supposed to be figuring out how to increase our own ability to supply ourselves, right? How do we turn on, refineries in this country? How do we figure out a solution to this problem that is both holistic and longer lasting, right? So everything seems a little bit haphazard, very reactionary, and we've got to get back to the table and sit there and almost make a war plan. How do we want to address energy problems? How do we want to address food problems? And I think we have to go back to rewarding companies for developing supply chains. And that's got to be the message we should be getting. It's unfortunately not the message we are getting.
Well, Pete, for a long time you talked about bringing those supply chains home. You were talking about that years ago. Pete, is that a theme that you can invest in still?
Yes, I think so. And I think, in fact, we've been talking a lot about bringing it back to South America, even Mexico. And as we go through these conversations, I think companies are taking a much closer look at proximity when they think about their supply chains. Not only are they looking at cheapness, but they're looking at risk of disruption, cost potentials. And I think everything kind of points you to having those supply chains closer to home. So I think you're going to see, some redundancies built in. I think you're going to see Mexico be a big beneficiary. And that is going on. And I think that's going to be a 3 to 5 year project. I think it's going to be inflationary. It's going to be steadily inflationary. And raising rates does not help that, right? Because it just causes companies to have to spend more to build out those plans.
That's exactly where I was going to go, Peter. A lot of these things are deeply inflationary, whether it's dealing with environmental issues, whether it's dealing with, frankly, just the higher costs of employment and being more safe and aware of what's going on. How much is that baked into the inflation assumptions going forward? Where do we end up for the next 3 to 5 years, despite the 2% target of the Fed?
I think we're going to be in that 3 to 4% consistent inflation level. And I think it's going to be for 3 to 5 years because of all this reshoring, this, rechanging of supply chains, this extra focus on, quote unquote, security. But you want redundancies. You're going to have larger inventories so that you're not subject to, supply chains being shut off. So all that's going to be steadily inflationary. I think the key is, though, so long as we are generating good jobs, those people who are getting the good jobs can keep up with inflation. So that's the important, I think that's where we need to be focusing on, is making sure that these jobs pay well enough, which they should, and then maybe figuring out how to support that, the people who are unfortunately being left behind. But I'm actually somewhat comfortable that the growth that I'm projecting, the way I see it playing out, it's going to create good, safe jobs that let people in this country do well.
So 3 to 4% inflation for 3 to 5 years. What does that mean for a 10-year yield that still is flirting with negative real yield territory at a time when we got the Fed starting Wednesday engaged with quantitative tightening?
I think we're going to have trouble getting much above 3%, although, in theory, we should be with that sort of level of inflation. But I think everyone's going to be aware that the Fed is going to kind of go through these series of where maybe they're behind the curve, maybe they've already done too much. And ultimately, as much as inflation's a problem, job growth is going to be a bigger problem. And you started hearing some of those earning calls last week and the week before where people are talking about maybe they have too many employees. So I think the Fed has to be very, very careful, because no matter how bad inflation sounds, job losses are even worse. So I think the Fed's not going to be able to be as aggressive as people think. And that's going to keep the 10-year, I think, in this 2.50 to 3% range for the next few months.
Pete, just before we go, I'd like to spend some time on this. You started your note yesterday by saying on this Memorial Day, I'd like to honour all that made the ultimate sacrifice in defence of our country. As many people know, perhaps they don't, Academy makes up a big proportion of the veterans over at Academy, are veterans rather. Pete, talk to me about that, the insight that gives you on issues like Russia right now and China for that matter as well.
I think it's been really critical. One is we have our geopolitical intelligence group, which is 14 retired generals and admirals and 1 retired astronaut. So I think we got a really different perspective on how these things play out. And when people talk about no-fly zones, we can understand what it means to enforce a no-fly zone, why we didn't do that. So I think that's been really important. And one thing we've been doing a lot in meetings is, although people still want to talk about Ukraine and Russia, we can't take the eye off the ball of China, because China is out there collecting commodities. They're almost sanction-proofing themselves. We're seeing a shift in behavior with China, and that is really going to be the long-term what drives our economic future, is what China does, not so much what goes on in Russia and Ukraine.
Pete, one more on that. Sanction-proofing themselves. What are you seeing them do, and what are you looking to do off the back of it?
I think this kind of ties into our theme of wanting to work with people that are close to us, because that's what China is doing, right? They're effectively lining up the autocratic nations of the world who tend to be commodity rich to sell China those commodities. China wants the commodities. They claim they'll be a good customer because they're going to be burning oil, coal, natural gas for decades to come. So that's where they're aligning. So I think we have to combat that by thinking, who do we want to partner with? Who do we want to work with? And that's changing that. To me, we're going to have this very much a Western Hemisphere alignment that we compete with.
Pete, awesome to catch up, as always. Peter Chair there of Academy Securities. On the elephant in the room in many places right now, Lisa, that's China.
It's all China, frankly. And honestly, people talk about Ukraine, but the issue of China, the issue of the lockdowns, what that does to the economy, the issue of Taiwan and a potential altercation there, the issue of what do you do if you have business in a nation that is so not transparent with respect to their health policies, as well as what kind of scrutiny they're going to have over you, is really the issue that a lot of people are dealing with.
That's the China situation. Tom, just going through the calendar through the summer, June 10th, CPI, July 13th, CPI, August 10th, CPI, all ahead of a big September meeting for this Federal Reserve.
Yeah, I'm going to get out to September, John. I think the two recent meetings are where they are, but to me it's September 21 and on to, I believe it's December 4th as well. These are key meetings, and again, they're massively data dependent, and in fact, the president will hear that today.
And ahead of that meeting at the back end of September, they'll get another read on September 13th on CPI. A lot of inflation prints for them to have a look back on and start to decide whether it still requires a 50 basis point frequency, an interest rate hike, something slower, or maybe a pause. Futures negative 0.7% on the S&P from a steamy New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word, I'm Ritika Gupta. President Biden will hold a rare Oval Office meeting today with Federal Reserve Chair Jerome Powell. Treasury Secretary Janet Yellen will join them to discuss what the administration calls the president's top economic priority, inflation. Rising prices are hurting the president, with voters just months before midterm elections. European Union leaders have paved the way for a sixth package of sanctions to punish Russia and President Vladimir Putin. They agreed to pursue a partial ban on Russian oil. It would forbid the purchase of crude oil and petroleum products from Russia delivered by sea, but there would be a temporary exemption for pipeline crude. That would satisfy Hungary, which gets Russian oil via pipeline. For the first time since early March, the number of daily coronavirus cases in China has dropped below 100. Still, Omicron's contagiousness means the reprieve from infections and the tough COVID-0 response may only be temporary. Both Beijing and Shanghai have started to loosen restrictions on mobility. More legal headaches for Deutsche Bank. Police in Frankfurt raided Germany's largest lender and its asset management unit, DWS. The search is related to accusations of so-called greenwashing by the asset manager. There have been claims that DWS was marketing investment products as being greener than they actually were. And shares of Unilever jumped today. Activist investor Nelson Peltz has been appointed as a director, and his Triumph Fund Management has taken a 1.5% stake in the company. The appointment comes after a difficult period for Unilever. CEO Alan Hope failed in an attempt to take over the consumer division of GlaxoSmithKline and has had to grapple with steep inflation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases, or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Earnings season continues.
There's so much nervousness in the market right now.
This market punches you in the face.
Bloomberg is fastest with the numbers and analysis.
Big numbers from Disney.
It just slammed expectations.
Bloomberg, the fastest numbers and analysis you trust.
Oil, there is still spare capacity, but that spare capacity is quickly running dry. It's mainly in Saudi, mainly in OPEC. Now, it's a good question, and oil prices should be higher if you think about the marginal cost to produce the oil.
And they are higher this morning. That was Christian Maley, the global energy strategist at JP Morgan Securities. Futures are lower by 0.6% on the S&P. Crude is rallying, though. Crude right now, Tom, crude higher by 3%, 118.62 on WTI.
Right now, on the shock of where oil is, and again, the 123.59 on Brent crude is nicely above the March moving average, however you want to mention it, truly out to new sustained highs. A good time to speak to Ellen Walder. Her book, Saudi Inc., is just absolutely extraordinary, senior fellow at the Atlantic Council. Ellen, whether it's Christian Malek and his team at JP Morgan or Peter Shearer, who we just talked to, everyone is screaming about investment in oil, and it can be at any part of the oil process. Do the Saudis want to lead OPEC Plus to a greater investment in oil?
I would say absolutely. And this is something that Amin Nasser, who's the CEO of Aramco, has actually been talking about for years now, although much more loudly, particularly since the Aramco IPO, is that investment in oil and in all parts of the oil chain has been so low for so long that even without this Russian crisis, you could say, right, oil prices would be higher simply because of this lack of investment. And we're not necessarily seeing a big enough response in terms of investment, except from the countries that have continued to invest in oil, like the UAE and Saudi Arabia.
How do we jumpstart the investment in hydrocarbons?
It's, I think it starts with an acknowledgement that we still need oil. We may not want to need oil. We may wish we didn't need oil, but if we want to continue with the way that we live, with our modern lifestyle, with driving cars and using airplanes and shipping things across the world, we need hydrocarbons. And yes, there are cleaner ways to produce hydrocarbons, and there are not so clean ways to produce them, but we still need them, and that needs to be acknowledged at every level, especially by governments, because when government support isn't there, investors and investment bodies take their cues from there, and they don't want to invest in something that they think the government is going to put extra taxes on or make impossible to use in just a few years.
Well, and Ellen, there's also a reluctance by investors to put their money into companies that are viewed as bad or viewed as contributing to global warming. Have we seen capitulation on that front as we see strategist after strategist say commodities are their favorite place to be?
Exactly, and I think that we're definitely seeing some people and some investors say, you know, so what? It doesn't matter. I don't care about the backlash. I don't care about public opinion. I'm going to put my money in this area that I think is going to make money, because at the end of the day, that's really what they're looking for, is a return on investment. Yes, they want to do good for the world, but that's really secondary to making money. And but you're still going to have some people and some investment places that are more concerned about public opinion, or they believe that public opinion is so strong that governments will continue to make these investments too difficult, and that will cut into the return on investment. And until we see a real, and in particular, especially in the United States, we need consistency in regulation. We need to know what's going to happen 5, 10, 15, 20 years down the line, not just, oh, well, everything could be changed with a new administration in 4 years.
Ellen, I'm going to ask you the same thing that we talked about with Christian Malik last week, which is, why aren't oil prices even higher given some of the shortfalls in production?
Yeah, exactly. I mean, we're seeing higher oil prices. I think that the market is still pretty volatile, and we're also concerned a bit about demand destruction at this point. We're seeing some pullback in consumption in the United States. There's definitely concern about China. Yes, we're hearing news that some of these lockdowns are being eased, and that's definitely going to impact demand, cause demand to go up. But as inflation gets higher and higher, it's really going to cut into people's use of hydrocarbons, of fuel, especially because these are things that are so high priced now.
Ellen Wald, within this conversation, sort of the out-of-body experience for me is it whether it's Exxon or Aramco or, an independent driller in Oklahoma or Texas, they're not waiting for the government to help them with investment. Why aren't they investing at $130 a barrel?
That's a really, really great question, and there are actually a bunch of reasons. Some of them are actually really well articulated by the survey that the Dallas Fed does of oil producers in the U.S. A lot of it has to do with cost. The costs of drilling now have gone up in a huge way. They're not able to get a lot of the materials that they need, so there are delays in terms of supply chain issues, and also they have been pressured so much to give this return on investment to their investors that they're really hesitant to take those profits and put them back into drilling, especially when costs are so high. They also can't get labor. There are labor shortages. Even if they pay more money, they still can't get people to come and work. So there are a lot of issues here. I think that some of these will work themselves out, but it's going to take months.
Ellen, thank you. As always, the brilliant Ellen Wald there of the Atlantic Council. Ramping up production is not that simple. The good news is that production in America is actually climbing and has been doing so for the last couple of months, Tom. I believe we're back to about 11 million barrels a day. Still off those numbers of, say, 13 from before the pandemic. We've got refining issues. It's difficult to ramp up capacity. We know we've got a capacity issue with refining. The energy players doing okay. They're doing better than okay. Last week on the S&P, those names were up by more than 8%. And year-to-date so far, and I have to admit I hadn't checked in on this for a couple of weeks, up 58.26%, Tom, year-to-date. That's the energy players on the S&P 500.
I'm not going to do buy, hold, sell on oil, John. That's not our job here. But I will say that when you look at a lot of the literature, whether it's from Royal Dutch Shell or, you know, the J.P. Morgan work we've cited, coal is sort of flat on its back. And other than that, you need a lot of investment across a lot of different makers of energy, whether it's solar or biomass or certainly hydrocarbons and gas.
You cited the work of J.P. Morgan. Bramo, capacity is a word that comes up again and again and again when you speak to Christian Malik.
Yeah, and it has to do with investments. It has to do with just how much you have to pay everybody, how much the actual materials have increased to also expend. But also, frankly, shareholders don't want those investments, right? I mean, shale producers in the U.S. have been penalized for overbuilding during good times, only to get busted during the bad.
And these are some better times for some of those names, that's for sure. Going by the stock price reaction anyway. Futures are down about 28, let's call it 29 and round down. We're down by 0.7% on the S&P. From New York, heard on radio, seen on TV, this is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
We are coming off the back of a big weekly gain, a monster weekly gain on the S&P 500 of just short of 6.6%. We trimmed some of that this morning. Good morning to you. Live on TV and radio, this is Bloomberg Surveillance with futures negative about 0.6% on the S&P, on the Nasdaq down by 0.4%, and yields breaking out just a little bit more in the last 15 minutes, up by, let's call it 13 basis points, Tom, now on a 10-year, 286.58.
John, I'm glad you mentioned that. We're 7 basis points and now out 12, 13 basis points. And it's so much of a yield lower move last week while you were in Capri that we're really back to center tendency.
Bostic versus Waller, Tom. It's as simple as that.
Yeah.
President Bostic last week suggesting we could pause rate hikes. Governor Waller yesterday saying anything but. He's looking for more moves to get inflation back down towards 2%. Yeah. After we had Bostic, maybe the data started to validate that idea. Perhaps you had that idea going into the minutes and the minutes confirmed what you already thought. Tom, coming out of it, listening to the Fed governor, there's no consensus on that pause anytime soon.
3.1% move in West Texas Intermediate. Right now, and hugely anticipated, Leland Miller is co-founder, the chief executive officer of China Beige Book. But far more, he is someone with his pulse on the Chinese data. The dynamics is taken from the micro data of China. He joins us this morning. I want to talk, Leland, about the Shanghai calculus, about the rate of change, the second derivative, the rate of change of the rate of change that the government in Beijing needs from Shanghai. How desperate is Beijing for Shanghai to get it going?
Well, they're very desperate, first of all, because Shanghai is a growth engine, but second, because it's a confidence engine for the economy. And what's so curious about, the PMI data that came out last night, a few days after an extraordinarily panicky meeting, something we haven't seen in decades, all of a sudden the data come out last night and they're improving from May. April was bad, but May's getting better. That's the opposite of what we saw in China Beige Book data. We actually saw much more problems in May as the secondary consequences of the lockdown spread away from Shanghai. So, they want to tell a pretty story right now. It's important for markets, but, we did not see an improvement from April to May. We saw the opposite.
So, Leland, give us a sense of what the China Beige Book is charting out to the end of the year in terms of GDP, the real GDP of China, not necessarily the 4.5%, 5% that the Communist Party would like to say.
Well, look, if you assume the second quarter is in contraction, no matter what they do, or give or take a little bit, then, the question is, what are they going to do the second half of the year without rolling back COVID lockdowns or COVID zero lockdowns, if they need them, to get the GDP somewhere in a range that they can claim. I think that the new calculus is we're going to get to the fourth quarter. We're going to hope there's no COVID, and we're going to announce, 5% GDP for the fourth quarter and try to get it somewhere between 3 and 4% claiming 3 and 4% for the year, then I think markets will say, okay, that's not too bad. We are not on track for anywhere near that. You have to have a lot of more support for the economy and a lot less COVID lockdowns in the economy in order for us to get anywhere near that ballpark amount. But I think that's the story they want to tell. What
are we on the ballpark for? What are we on track for based on the China Beige Book data?
Well, I mean, with the second quarter as weak as it is, and if you try to do any type of linear projection, you're under 2. You have to see a lot more support for the economy, which I do think we'll do. As we get close to the Party Congress, we do expect there to be more credit support. We do expect there to be a little more infrastructure. That's not surprising, but you're going to have to see a lot more of that, and it can't be interrupted by lockdowns across the economy.
Leland Miller, Deng. Years ago, to get rich is glorious. How far are we removed from that in this Chinese crisis?
I don't think we're that far away from it. If anything, some of what we've been taught over the past 6 months is that the Chinese model is not actually any more superior than any other model. They just had COVID at a different time, and now they're getting hit pretty hard with it. So everything has to get through the Party Congress. Xi has to have his political moment, and then they can start recalibrating the economy and the stock market and the regulatory system.
Do we underestimate the unchanged China that Deng said to get rich is glorious, and that's what they want to do? And do we overestimate right now the Xi totalitarian shift?
I think we did until a few weeks ago, but I think what's seeing all this, headline conflict between Xi Jinping and the ostensible number 2, Li Keqiang, I think people are understanding how much opposition there is within China in the leadership amongst people who are being locked down to this COVID-0 lockdown policy and to this slowing economy. And so we are now seeing the dirty side of China's governance right now, and I think people are more aware of it.
Leland, a lot of people have been looking out and wondering what we're going to see with respect to U.S. businesses, multinational businesses, and supply chains, why we haven't seen more of some sort of removal from certain facilities in China elsewhere. Are we now starting to see that after years of speculation?
I think so, and for one reason. The trade war didn't do it, COVID didn't do it, but the lockdowns are something else. And I think you're going to have a very hard time, not just getting Western businesses run across China, but getting expats or anyone to work at these businesses. Nobody wants to be in China right now. No one wants to be locked down and they can't see their families who may be elsewhere for a year, for 6 months, for longer than that. So I think this has shifted the calculus for people who want to live in China. It's made it much more difficult, and they're going to have a much harder time running businesses in China because of it.
U.S. executives are not going to come out and say that they're getting out of China, right? Because they're not going to say that until they already have. They don't want to hamper their employees who work there. They also don't want to get some blowback from the Chinese government. How much have you seen this withdrawal? I mean, this is basically the big question for a lot of companies that have been pretty quiet on this.
Well, I think it's telltale that just about everybody I know is either out on their way out or has already left. And there's very few people with plans to go into China anytime soon. I mean, it's just very difficult to travel, and it's very difficult to operate, live. So people don't want to accept that.
Link that change to the party Congress then later this autumn.
Well, I think what the party Congress does is she has his moment, and then after that, they can recalibrate certain things. If they need to change COVID-0, they can change COVID-0. If they need to...
But Leland, I don't mean to interrupt, but can they even spare the time to get to December or January of next year?
I don't see how they do it. They have to be extraordinarily lucky, and they have to introduce vaccines. And even by the Chinese reckoning, they say they're not going to be introducing them until October. So they're having some very, very difficult conversations now. This is far and away the worst conditions that we've seen in years, and there's no way out if COVID returns. So. You have to be crossing your fingers. If you're thinking China is going to really improve in the second half, you are crossing your fingers. Both the policy support will be there, and also that COVID won't just come and knock them off their feet again.
Leland, that's the story of this cycle and the economy. I wanted to finish on something really important. I think, as we've both observed over the last 10 years, it was clear and obvious to a lot of people the trajectory of some of the policy out of Russia and where this might end up. There are some people who have turned around in the last few months and have acted surprised that this has actually happened. Many others aren't surprised at all. Do you foresee the same thing happening further down the road with China? There are allegations of human rights abuses, genocide. Those allegations have come from a range of countries. The US, UK, Canada, and the Netherlands have all accused this country of committing genocide. There was a latest bunch of files last week obtained by a series of media groups, reporters, journalists, Leland, speaking to some of the detail around those human rights abuses. And yet, Leland, it's largely absent from the conversation of corporations engaging with the Chinese Communist Party and the economy there. It kind of sets us up for me, Leland, in a similar story to Russia. They ignore it, they ignore it, they ignore it, and then we get further down the line and they can't ignore it anymore. Where do you see this going?
Well, they're ignoring it in public conversations, but they're talking about it in private. And I think what most of these companies are up to right now is trying to understand whether they're going to have to completely separate their China business, their domestic China business, from their business from the rest of the world. And I think that the more that there is a political imperative to have one set of views on the Western side and find certain things unacceptable, and another view that reflects the Chinese Communist Party's views in the mainland, a lot of these corporations, they may not pull out of China, but what they may do is separate their China business from the rest of the world business. And we're talking about separated supply chains, separated corporate entities. This is a big, big change. Folks don't want to be talking about it, but they're absolutely planning for it right now.
Where would that leave a company like, say, Apple? Where would it leave them?
Well, Apple, would have to produce what it produces for Chinese consumers inside the country, and then it's going to have to find a lot of extra production capacity in Southeast Asia, in Mexico, and other places to produce all these, iPhones and iMacs and other things for the rest of the world. So what they're not going to be able to do is rely on Chinese production capacity for most of their production going forward. And they're absolutely trying to work out contingency plans, but it's harder for Apple than just about any other country in the world. So they've got enormous headwinds specifically in the next couple of years.
Leland, really interested to get your thoughts on those questions. Thank you, sir. Leland Miller there of the China Beige Book International. Bramo, an important topic that is being discussed, and according to Leland Miller, being discussed a whole lot more behind closed doors.
Yeah, and actions actually being taken. CEOs do not want to come out and say anything with respect to withdrawal from China because they will get blowback. But what they are doing on the ground, according to Leland Miller, is very different, and that has incredible implications, not only for China's GDP, but frankly for inflation at a time when that's going to be inflationary to rebuild supply chains elsewhere.
Futures right now down about 0.75%. There has been a change in the bond market in the last 20 minutes. Not a change of direction, but maybe in a magnitude of the move. Yields are higher by 13 basis points on a 10-year to 286.58. Just a few words from Governor Waller. That's all it took yesterday, Tom, to suggest that he sees a lot more rate hikes in the future to get inflation back down towards 2%.
Now, some legit dollar strength as well. The euro was a 107, now 106.86, and that bears watching. And it's confirmed by Euro Swissy coming in. You really wonder some of the tensions there beneath the headlines.
Looking forward to catching up with Savita Subramaniam of Bank of America a little bit later this morning. We'll catch up with her in about 20 minutes on Bloomberg TV. Alongside her, Peter Cicchini of Exonic and Michael Purvis of Tallback, and on the situation in this equity market and which side to be on right now, with President Bostic or with Governor Waller. The Bank of America view just around the corner. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. European Union leaders have agreed to back a partial ban on Russian oil. It would be part of a sixth package of sanctions aimed at punishing Russia for invading Ukraine. The sanctions would ban the purchase of Russian oil and petroleum products delivered by ships, but it temporarily allows EU nations to buy Russian oil delivered by pipeline. That exemption is needed to get Hungary to sign on. The CEO of Soros Fund Management says the U.S. is on track for a recession. Dawn Fitzpatrick was interviewed for Bloomberg Wealth with David Rubenstein.
There's a lot of discussion about a looming recession, and the bottom line is a recession is inevitable. It's a matter of when. And when you look at what markets are pricing here, they're pricing it fairly soon. So in the 2023 context, depending on which asset classes you're looking at, I actually think markets might be wrong. And the reason is the consumer right here is in extraordinarily good shape.
Watch David Rubenstein's exclusive interview with Soros Fund Management CEO and CIO Dawn Fitzpatrick tonight, 9 p.m. New York time on Bloomberg Wealth with David Rubenstein. The town of Uvalde, Texas, has begun saying goodbye to the 19 children and 2 teachers killed in last week's elementary school massacre. Visitations at the town's funeral homes were held yesterday for 2 10-year-old girls. This week alone, 12 funerals are planned. Meanwhile, lawmakers have said they'll consider what can be done to stem gun violence. It's Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We have unique economic strengths right now, the job market and the labor market being chief among them, but not the only one. Household balance sheets are in a very strong position. We're seeing business creation, small business creation up at record levels. So we have unique economic strengths which position us well now to focus on this challenge, which is bringing prices down.
A spirited conversation with the National Economic Council Director, Brian Deese, who I believe will be serving tea today. For the President, the Secretary of Treasury, and the Chairman of the Federal Reserve System. Look for that coverage on Bloomberg at 1 o'clock on radio and television. Lisa Bramlett and Tom Keene, John Farrow in treatment for his next property right now.
In treatment.
And joining us right now with the clearest note of the morning is Tom Satoris, head of fixed income research at Strategas. It is a Baird company. I love the clarity of your note that Biden, Powell, and Yellen have easy lifting down to a 5% inflation rate, but then. Is that really going to be the topic today on the couches in the Oval Office?
I think so. And the Biden administration has a very real problem here. They've got to get inflation down to a more comfortable 3%. But the problem with that is getting it down to 5% is pretty easy. It's just seasonality, it's base effects.
Right.
Tightening will get us down to about a 4%, but getting down to a 3% probably is going to engineer a recession, and that's the real difficulty that both the Fed and the Biden administration have.
Are the PhDs at the Eccles Building looking at reaction functions and virtually differential calculus of the how to go from 5% to 3% inflation?
I think they are, but the question is, do they over-tighten along the way? If you look at the past history, the PhDs have said, keep going, and eventually something broke before they actually got to their model-driven end game. And there's a very high chance that happens again this time as well. They over-tighten and a recession ensues.
Tom, what kind of recession would it be?
Well, at this point in time, probably a fairly shallow recession because as has been mentioned, I believe Brian Deese had mentioned it earlier on the show, you're looking at a very good cushion right now for the consumer base. Home prices, cash out refis, and very strong wage inflation. So a recession should be shallow at this point unless the Fed really makes a mistake or there's another shock that we're unaware of.
Tom, do you buy this feeling that we heard last week that Raphael Bostic's train of thought was the right one, that there'd be some sort of pause in September or possibly after that when the Fed reassessed and decided to pull back from some of the tightening? Or do you think that the market is underestimating right now the resolve at the Federal Reserve?
Yeah, I think a pause is inevitable, whether it happens in September or later on this year. A pause could very well mean a slowdown to a 25 basis points per meeting rate hike path and really no change to the expected terminal Fed funds rate, and balance sheet reduction continues to proceed. I really don't think we're going to see a pause in the sense that the Fed basically stops tightening.
To fold in your work with Jason Trenner's work at Strategas, does the market do the heavy lifting for the Fed? Does the market get out front on this and create a tightening atmosphere?
Well, the market does, but we estimate the market so far has done the equivalent of about 160 basis points of tightening. So if a neutral Fed funds rate is 3%, and inflation is basically running at a sticky state of 4%, there's a more tightening to come from the market. So the market has more tightening to go.
Okay, if a neutral Fed funds rate is 3%, what does that mean for a 10-year?
That means if we're still looking at a 4% sticky inflation, that means a 10-year has to be at or above 3%, but perhaps not by much. We'll say somewhere between a 3.25 to 3.35 is where you'd expect the 10-year to kind of deposit as a terminal rate, and it very well may come down below that fairly quickly once again.
So basically, has the Fed already been priced in? I mean, that's been basically the theme, that the first half of this year has really been about pricing in the rate moves, and the second half of the year will be pricing in the recession that you think is almost inevitable. Is that how you see it?
Yeah, I do think so. The Fed tightening path or rate hike path has been priced in, and that is a market pricing now somewhere around a 3 to 3.25 Fed funds rate. What's probably not priced in is, one, a full recession risk, as evident by an S&P 500 about 4,100. But also with 10-year yields, even at about a 286 as of this morning, you're still talking about 10-year yields below what the market expects the terminal effective Fed funds rate to be. So the market really isn't pricing in balance sheet reduction risk. And the same is true for mortgage spreads. You just don't see the spreads at levels that would indicate stress there.
Let's go back to your wheelhouse, which is Fannie Mae, and as you just mentioned, mortgage.
Yep.
You're not mere mortal on this. You're actually a god of studying Fannie Mae and housing data. How askew is our housing boom, or is it normal what we've seen?
Well, I think it's normal in the sense that you have a backlog, a queue of housing demand from the last decade that was probably pushed forward by bad policy coming out of 2010. And you also have had an underinvestment in housing. So now we're kind of playing some catch up. You add to that the fact that nominal growth has been pretty high, as well as very low mortgage rates. Even mortgage rates today, 5.25%. It's below nominal growth. So housing demand is strong. It's consistent with where you'd expect it to be. The question is, can home price appreciation continue at this pace? And the answer is almost certainly no.
So the second home that Lisa bought up by Tupper Lake with 800 acres overlooking some portage, and I think it's called Blackfly Camp.
Literally, you have scars from that,
She's not going to break even for 15 years? Is that what you're saying?
Well, I'm not going to make an individual base case call, but if I were buying at these prices right now, I'd be looking at demand softening over the next 12 to 24 months and potentially some seasonal weak spots where housing actually turns lower over the next 2 years.
What do you think, Lisa?
I think that you have some real memories about portaging and black flies. That's what I think. Tom Soros, thank you so much.
It's the time of year, Tom.
Yes.
Tom, it's black fly season, right, Lisa?
It is. Are we going to keep going with black flies? I am very much looking forward to black flies in our annual family vacation up in the Adirondacks. We'll be enjoying it. It'll be fantastic. Lots of portaging for the kids, Tom.
Not one single chemical has ever worked in the skin against a black fly.
You're not wrong about that.
Thank you so much. Strategas here. But, Lisa, I bring it it up because it's his wheelhouse. It's what he's acclaimed for when, Jason brought him on at Strategas years ago. I'm not hearing enough about the housing outcome in America.
I think it's a good point that you're making right now, that perhaps we're not going to see a blowout of the entire pricing model like we did in 2008 and 2009, but we might see a lost decades of profits, particularly in certain areas. I don't know the answer to this. It's going to be really curious, especially at 9 a.m. when we get some data.
Lisa, oil, Brent crude popping 124 print moments ago. That's a wow statistic.
That's a wow statistic at a time when a lot of people say there's more to go.
Did we miss Pharaoh? I think we did. I thought, we got through it.
We got through it. We missed him.
We're not on speaking terms, but it worked. Good morning.
Welcome back to another special Roland Garros update for Bloomberg TV and radio from Tennis Channel. I'm Erin Coscarelli. The biggest upset of the men's draw so far on day 9 in Paris. 19-year-old Olga Rune clinched the biggest win of his career as he took out the number 4 seed Stefanos Tsitsipas to reach the quarterfinals. The Dane is making his debut at the Clay Court Slam and was playing in his first 4th-round match at the majors. And on the women's side, world number 1 Iga Swiatek notched up her 32nd straight victory as she got past Zhang Wenjun in 3 sets. She'll face Jessica Pegula for a spot in the Final Four after she fought back from a set down against Irina Camelia Begu to reach the Elite 8 for the first time. And don't forget, Tennis Channel's daily live coverage from Roland Garros hits the air at 5 a.m. Eastern. I'm Erin Coscarelli.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Yields up, stocks down. Live from New York City this morning. Good morning, good morning. We're down 0.75% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue, looking for signs of a bottom.
We've seen a nice little rally.
Certainly a relief rally of some sort.
The NASDAQ climbed 1,000 points off the bottom.
What you see is a bear market rally.
Bear market rally.
Setting the stage for a bear market rally. We don't believe that.
It's too soon to tell. Looking at a 1 week rally after 7 weeks of pretty significant carnage.
A lot of breadth thrust to the downside.
You have to be careful.
Inflection points are happening daily.
Maybe you get your bear market rally, but the bigger picture here is that valuations are in a long-term kind of reevaluation.
If companies can keep delivering here, then we will build that bottom and we will start to have a rally.
There's a strong likelihood that even in September, October, we're going to see a repeat of what's happening now in the markets.
The risk is still there.
After a big week of gains, joining us now to discuss is Bank of America's Savita Subramaniam, Peter Cecchini of Exonic Capital. Let's begin with you, Savita, an easy one. What's the difference between a bear market rally and something more substantial?
Well, it's hard to tell at first, but I think that, a bear market rally is just a little bit of a relief rally or a position-driven rally, driven more by kind of selling fatigue than anything else. I mean, I think what's interesting now is that, the question is, where will the market bottom? When will the market bottom? I think the range of outcomes is actually, the floor on the market is actually, not as horrific relative to today's levels as one might imagine. So here we are at around 4,000, and we calculate that a floor on the market is 3,200, even in a recession case. So I think the idea here is pick your spots. Maybe we're not at the absolute bottom, but there are some areas within the equity market that are likely to be, some of the best opportunities, some of the best entry points that we'll see in this sell-off. So that's our view, is sort of focus on the spots within the market rather than just calling where the market bottoms out as a whole.
And just to be clear, Savita, just on the market from the headline number on the S&P, your base case is not a recession, right?
Exactly. Our base case is not a recession. Our base case is that some of this inflation pressure that we're seeing abates. We think that cash on balance sheets is healthy for corporates and consumers. I think the fact that we're getting this question from clients, give me a reason to be bullish, is a bullish sign. I mean, folks are bearish out there, and sentiment indicators have turned to a point where it would indicate that there are more bears than bulls in the market, and that is usually a better sign of a bottom than when there are more bulls than bears.
Peter, if you're struggling for a reason to be bullish, is that reason enough to be bullish?
For me, it's not, and for us at Exonic, it's not. I think the idea right now is that there are a plethora of asset classes in which one can engage outside of equities, where one of our big focuses here is structured products, and protecting your downside in markets like this by investing in cash flowing assets that are somewhat protected from inflation is one of the ways that you can actually express a bullish view outside of equities. This market action right now feels a lot like market action we've seen early on in longer-lived bear markets. I think about late 2000, early 2001, late 2007, early 2008. You have sort of 15 to 20% market sell-offs. People become overly bearish. There wasn't a bear to be found late last year. Now everyone is bearish. That sets us up for a rally. Unfortunately, the boogeyman here remains inflation. And it's pretty much already done its damage. And this idea that the consumer is in fantastic shape, I just think is spurious. When we look at personal savings, it's well down below $1 trillion now from its peak at 6. That was a very important piece of the equity market rally. And the wealth effect has been incredibly important relative to the transmission mechanism for policy in a way probably never in history. So I think the strong consumer recession avoidance argument really doesn't ring true for me.
Savita, what's the counterpoint to that?
Yeah, I mean, it's not just the consumer, it's also the corporate sector. And I would argue that, maybe the consumer is not as strong as they were, right after they got their fiscal stimulus and hadn't spent any money. But today, what we're seeing in our credit card data is that spending is still quite healthy relative to inflationary pressures. We are seeing some pressure in sort of the lower income cohort, but I think overall, what we're seeing is an environment where cash balances are actually higher than they typically are coming out of a recession, which, we had a recession last year, and we actually have seen less leverage taken by corporates and consumers over this cycle. And I think what's also interesting, and this is not necessarily true, a benefit to the market, but it could be a benefit to the U.S. economy, is the idea that companies are actually, kind of in a position where they really need to spend capital, and they have capital. So one of the things that never fails to surprise me is that our CapEx guidance ratio continues to be above trend, despite the fact that companies are guiding lower on earnings expectations, et cetera. So look, I'm not an Uber bull. I think there are lots of problems with this market. We are underweight high growth tech. I think there are pockets of the market that you still want to avoid. I think we're going through a massive regime change where the pressures are inflation, rising interest rates, energy prices at levels that we haven't seen in quite a while. And these are probably stickier than they have been in prior cycles. But I do think that equities offer inflation protection and cash return, and I think those are the two characteristics where I would agree with my colleague here that cash return or cash allocation and inflation protection are paramount. Where can you get those things? Well, a lot of equities have them: energy, financials, even healthcare staples. These are areas of the market that are less susceptible to the vagaries and the negative impacts of inflation, but can actually benefit from a pickup in inflation and are relatively healthy and paying healthy dividends relative to fixed income and other parts of the capital spectrum. Where I wouldn't go is bonds. I still think that bonds are in a bear market.
And you didn't mention tech either, and we'll talk about that in just a moment. Futures negative going into the opening bell, about 23 minutes away. We're down 0.6%. Coming off the back of a monster week of gains on the S&P, up by more than 6 percentage points and snapping the longest losing streak on the S&P going back a decade or so. Let's get to Kaylee Knights for more. Hey, Kaylee.
Yeah, John, snapping that losing streak that actually was the longest since 2001. Following that, though, best week for the S&P 500 since November of 2020. One good week is not enough to undo all of the damage this equity market has seen so far this year, but still this rally was pretty notable. And what else was notable was that it wasn't limited to equities. You really saw gains across all of the major asset classes. Treasuries rallied, price up, yields down for a third straight week. That was the longest since early December. You had investment grade and high yield credit jumping, each having their best week in almost 2 years. In commodities, that Bloomberg Commodity Index is back toward an 8-year high after gains we saw from oil. To focus back on stocks in particular, though, we have to keep in mind the S&P 500 has still seen its worst start to the year since 1970. There has been a lot of bleeding that has actually brought valuations down to their historical average. So maybe now that is creating an entry point for some investors with the urge to buy the dip really kicking back in. But we also have to consider that short sellers may have contributed to the gains we were seeing. Forced to cover some of those wagers, SPY, the S&P 500 SPDR ETF, saw its short interest as a percentage of shares outstanding decline for 7 straight days. The real question, though, and Savita mentioned this, is whether or not buyers are going to come back into tech in particular, because that is where so much of the pain and drag has been concentrated. Information technology, consumer discretionary, communications collectively have seen almost $5 trillion in market value wiped out so far this year. And even the remarkable gains for the sector like energy, far and away the best performer in the S&P 500 year to date, only $633 billion. Of course, that sector only has about a 5% weighting in the index overall, John.
Kelly Lights, thank you. Savita asked the question. Here's the question that Savita asked. When is it time to buy tech? It's the question that she's hearing again and again and again from clients. Here's her answer. When clients stop asking this question, their muscle memory of making money on dip buying in tech needs to fade before it bottoms, in our view. Savita, when is it time to buy tech? You say when clients stop asking this question. Can you build on that a little bit more?
Yeah, absolutely. I mean, we kind of saw this in 2000. I remember I was working at a value fund, and there was this, reticence to give up on the tech theme. And I think it's really the idea that you need to wait until the sector is sort of washed out. It's still very crowded. So when you look at positioning within the technology sector, we're still seeing something close to a 30% overweight within the TMT sector. And I think that's got to change before you find a good entry point for technology stocks. This is active long-only managers. So they really haven't given up their bullishness on the tech sector. Remember in the tech bubble, it took about 3 or 4 years for investors to sort of forget about technology, for these companies to consolidate capacity, shore up balance sheets. It was a longer process than a few months. And I think that's what we need to remind ourselves. Value cycles can last for a long time. On average, they last about 6 or 7 years. And we're only in, year 1 or year 1.5, depending on where you started. So I think this is one of those markets where, a lot of investors haven't really seen a market like this. They've only seen tech dominance, and it's going to take a little while to acknowledge and accept the fact that tech doesn't always outperform every other stock in the market.
And Peter, final word here. Are you on the same page?
Yeah, relative to the latter point, absolutely on the same page. I think the one distinction that's important to draw is that I see the consumer credit card data and the consumer credit data overall at 50 billion change on the last print is actually something of a negative, because the savings rate is falling and consumers are being forced to reach into to spend on their credit cards because of inflation is so hot.
Peter Cecchini, Savita, sticking with us. Going into the opening bell about 20 minutes or so away. Futures slightly negative with more. Here's Abby. Hey, Abby.
Hey, John, welcome back. And we are seeing a little bit of a slide here for U.S. futures, a bit of a pause after last week's big rally. And one of the reasons Apple, after the best week of the year, up more than 8% last week, Apple is taking a break, down about 0.5%. Not a big decline, but we do have yields pushing higher, so that could pressure tech in terms of valuation. American Airlines is down 2.4%. This, of course, after oil higher is helping pushing airlines lower. Carnival Corp travel down also as oil is lower. And then finally, Snap lower, John. This, of course, as Vertical has cut these shares to a negative. So the negative spending around ad spending for social media in question, causing Snap to decline.
Abby, thank you. Good to be back with you. We'll get you some morning calls a little bit later in the program. Coming up, an inflation summit from the Oval Office. President Biden, Chair Powell, Secretary Yellen in the same room this afternoon. That conversation up next.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
We have unique economic strengths right now, the job market and the labor market being chief among them, which position us well now to focus on this challenge, which is bringing prices down. Obviously, the Federal Reserve plays a primary role in that, but fiscal policy and the economic choices that we make with Congress play an important role as well.
The main event today, President Biden, Treasury Secretary Janet Yellen meeting with Fed Chair Jay Powell today to discuss inflation. The White House writing in a statement the following. Yellen will join President Biden and Powell to discuss the state of the American and global economy and the president's top economic priority, addressing inflation. Joining us now from D.C. is Bloomberg's Anne-Marie, alongside Maria Tadeo in Brussels. AMH, straight to you. What can we expect from this beyond just a photo op?
Well, Politico is billing this June for the president as a pivot to the economy. But Jonathan, as you say, many are just guessing this is going to be a photo op. So maybe it's a performative pivot. What is left for this administration to do when it comes to inflation? You heard from Brian Deese speaking to you, Tom and Lisa earlier. Similar sentiment we heard from the president last night, an opinion piece in the Wall Street Journal, that inflation, this is in the realm of the Fed. It is their priority to deal with price controls, and he respects an independent Fed. So that's really likely kind of the tune and tone of what the start of this meeting is going to be. The press will be allowed in for the top of that meeting. But it does show to the American people that this is what the president says, his top economic or top domestic priority.
Anne-Marie, forgive the snark if it sounds like there is any, but to pivot to the economy, where have they been for the last 6 to 9 months?
Well, I think the economy has obviously always been top of mind, but really it's been framed over the past few months as a lot of the price pressures Americans are feeling is because this war in Ukraine, the Russia's invasion of Ukraine. And the president's opinion piece last night mentioned that, but he said inflation was here and the war has exacerbated it. And that's exactly what we've been talking about. This was always going to be a problem coming into the summer and the fall of this year, but Putin has exacerbated that. And really, Jonathan, you could just feel it today, right? It's the day after Memorial Day, and it is another fresh record for Americans filling up at the pump, $4.62. It's about 50% higher than where prices were last Memorial Day.
$4.62, and it could go higher. Driving season starts. And Maria, in Europe, I believe there is a plan to pursue a ban and not a deal. What have we actually got in Europe?
Yeah, and you know, it's funny because to pick up on what Anne-Marie just said, the line that we hear in the European Union is very similar, that yes, inflation is going up. We see that prices, particularly to consumers, are going through the roof, but they talk about this concept of imported inflation. They say all of this is happening as a result of the war in Ukraine. So it's a very similar line that they take here in Europe too. Now, when you look at what was agreed yesterday, this is a partial oil embargo. Of course, it will affect seaborne imports of Russian Federation oil coming into the European Union. They say just this ban alone will put an end to 2/3 of the purchase that we see of Russian energy, of oil in particular, coming to the European Union. But the other thing that's interesting here is that there is an exemption to pipeline oil. But yesterday we had the Germans saying they want to put an end to this by the end of the year. So if they do what they say out loud publicly that they will do, we could see a reduction of Russian oil into the EU of 90% by the end of the year. What I would note, however, is that after this, today spoken to a number of officials, and they all kind of hint when it comes to energy, particularly going back to the inflation story, we've probably reached the limit for the European Union for a while.
Maria, great to catch up. Inflation surprise after inflation surprise, and a wrong kind of upside surprise in Europe right now, that's for sure. AMH down in DC, Maria Tadeo in Brussels, back with us, Savita. Peter, Savita, on energy, you say the pain trade in energy is up. Why?
Well, it's interesting. Nobody owns energy. They want to own energy, but it's really hard to hold because of, the emissions and the sort of the negative optics around the sector from just an overall, the idea that oil has a terminal value of zero over time. First of all, we think that's not necessarily true. We think that investors who are looking for ways to own energy without accessing energy are paying up for energy like industrials or materials or stocks that act like energy but don't have the emissions risk. Second of all, we think that energy companies are actually, they kind of got the ESG memo, and a lot of these companies are on a path towards improving their emissions, as well as, the idea that we need oil to get to net zero. We're not there yet, and we need oil along that path. So I think, what we're seeing is a lot of investors that want to play this oil price, this commodity upcycle, but are still fearful of owning the actual energy companies. We say own energy. It's still super cheap. It's still really underweight in the average long-only fund and the average hedge fund. These are companies that are returning free cash flow that is 9 percentage points above tips, which is another way of getting inflation-protected yield. So we think it's cheap, it's reviled, but it's really the best way to get exposure to the commodity price upcycle.
You can see why they're nervous, though, Savita. We've had a 60% gain on the S&P 500 in energy names, close to 60%. And Peter, for some people, they believe this could be the part of the world, of the market, commodities, energy, that takes down the cycle. And if the cycle rolls over, that's the last place you want to be. That's the view of some people, Pete. Is that the right position to take?
Well, you might have asked me that question because that's my position. As you know, for many months, I've been coming on your show and I've been saying, equities, especially tech, overvalued. In an inflationary environment, get long energy, get long commodities. And I think it's an important bifurcation that's going to begin to occur within the commodity complex, where staying long energy is going to make sense for fairly obvious reasons, the conflict, the war in Ukraine being chief among them. That said, there is now a reflexive impact of inflation on demand, and that's going to start to affect hard commodities like copper, like lumber. We're seeing a reversal in their prices as we speak. And so I think it's going to be, it's going to be very difficult just to say be long commodities, be long energy, be short hard commodities. Soft commodities like wheat, for example, will probably also have a bid given the supply chain disruptions from the war. But again, I think we've moved past that sort of pivot point where hard commodities are now a better sale than buy, in my view.
Savita, I just want to finish on that. The risk around this story, and I guess the counterpoint, the other side of the argument, the other side of the trade, this view that the winners of this inflation story would ultimately be the victim of the rate story, of slower growth. What do you say back to it?
Well, okay. So first of all, I think that the idea that all commodities are created equal is absolutely false, and I agree that hard goods and lumber and metals, where we're seeing actual demand for big ticket items taper off. That's an area you probably don't want to double down on. But I think the idea of oil kind of killing the economic cycle, I mean, certainly we've seen that in the past. We have seen stagflationary environments where, just the spike in oil prices was enough of a draw on consumers' wallets that we actually saw declining oil demand and declining demand for everything else, and that threw us into a recession. So that's obviously what we're watching very carefully. I think what's interesting right now, and the reason that I think that energy has more upside than downside risk, is that China is completely offline. Let's think about when China comes back online and reopens. That's going to be even more of an upward pressure on oil prices. So I think, you know, what we want to make sure of is that we don't enter a stagflationary environment. Just in case we do, the best sectors to own, which we're overweight, are energy, consumer staples, and, you know, some of the more defensive areas of the market. So I think that's the sort of appropriate positioning as a hedge against that stagflationary environment.
Savita, to your point, just the hint of China coming back online, crude making new highs again, WTI and Brent. Savita, Peter, great to catch up with both of you. Thank you. Coming up in the morning calls and later, Michael Purvis at Tallback and expecting the robust volatility to continue. Futures down 0.4%.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Stocks recovering just a little bit going into the opening bout. That's the price action. Here are your morning calls. Truist upgrading Dish Networks to a buy, highlighting the company's discounted pricing and potential partnerships. Morgan Stanley downgrading American Eagle to underweight, expecting the retailer to fall short of lofty second-half targets. And finally, Vertical Group downgrading Snap to negative, pointing to weaker than anticipated ad revenue. Coming up, Tallback's Michael Purvis expecting monster volatility to continue through the summer. Your opening bout this Tuesday morning is up next.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Coming off the back of the biggest weekly gain on the S&P 500, going back to November 2020. Kicking off this week after a long weekend stateside, Wall Street gets back to work with futures negative about 0.4% on the S&P. On the Nasdaq 100, pretty much dead flat on a Russell, a bit softer by 0.4% as well. Let's see opening bound in New York, switch up the board and get to the bond market. Yields drifting higher by about 9 basis points now. Off session highs at 282.78. And this started by Governor Waller. We'll talk about his words over at the Federal Reserve a little bit later this morning. Over in Europe, upside surprise after upside surprise. It is very much the wrong kind of upside surprise for Europe. Inflation, another record, 107.11, call it 10 on euro dollar, negative 0.6%. And crude, keep repeating this. I think Bank of America and Mr. Harner over there called this the sneaky rally in crude. It continues. WTI 119 and Brent cleanly through 120. Top of the pile this morning, as you might expect, is energy up 0.9%, about 30 seconds in. Here's Abby with the movers you need to watch. Hey, Abby.
Hey, John. Well, we'll be talking about that sneaky rally in crude in just one moment. But first, we do have a little bit of weakness here for stocks at the open, well off the pre-market lows. But the big laggard here, some of those big tech names, even with the outperformance for the Nasdaq 100, Microsoft, similar to Apple, down about 0.5%, just cooling off a little bit after last week's big week. Now, the airlines are very weak. United Airlines down about 3.6%. That could have something to do with that rally in crude, with WTI crude close to $120 per barrel, up for a third day in a row. On the other hand, as you were just mentioning, energy the best sector. ExxonMobil is a big winner, up 1.4%. And then Bitcoin, after being below $30,000 per Bitcoin for quite some time, now popping back above, taking lots of those names, including Riot Blockchain, up 6.7% with it. Bitcoin, John, technically confirmed to go back to $40,000 per Bitcoin. Let's see if it happens.
There we go. Abby, thank you. About a minute and 30 seconds into this, we're negative 0.4 on the S&P. Bottom of the pile, utilities down about 1.1%. We talked about what's top of the pile, energy up by 1.8%. Over on the Nasdaq, also coming off the back of a decent week of gains after the longest weekly losing streak going all the way back to 2011. Ed Ludlow has more. Hey, Ed.
Good morning, John. We're down 0.1% on the Nasdaq 100, despite that weekly gain of more than 7%, the biggest weekly jump since March on the Nasdaq 100. The narrative is still there that the bear market in technology stocks has legs to run. The pain that we've seen is far from over, and kind of the loudest among the voices saying that is Bank of America quantitative strategists led by Savita Subramanian. 4 issues, right? The prospect for higher rates, slowing global growth, peak globalization, call it what you will, tough comps with the boom era of the pandemic, and then finally, we've seen dip buyers coming in at a time where institutions still have pretty strong overweight holdings in the technology sector. Growth and recession fears interesting. You look at valuations, we're trading at 21 times forward PE, 12-month PE on the Nasdaq 100, and I heard one of your guests earlier talking about how valuations are still too high when you consider this inflationary environment. Look on the Bloomberg terminal among the most read stories, Morgan Stanley's Michael Wilson saying the key fundamental call they're focused on, slowing growth, and their view that earnings estimates are too high. Too high, John, at 21 times.
Ed Ludlow, thank you. We got that quote from Mike Wilson over at Morgan Stanley. Ed, thanks again. I'll get to that quote now. It's difficult to construct a case for more than a bear market rally. Mike goes on to say, which could carry another 5%. But this is the punchline, the bottom line for Mike Wilson and the team over at Morgan Stanley. He says inflation remains too high for the Fed's liking, and so whatever pivot investors might be hoping for will be too immaterial to change the downtrend. I'll get Michael Purvis's thoughts on that in just a moment. We're down about 8 or 9 tenths of 1% on the S&P. Kaylee Lyons, Wall Street is always divided. It's still divided.
Yeah, and it feels like Mike Wilson of Morgan Stanley is always on the bearish side of the equation, and others always lean in the more bullish direction. But so goes the story, and it takes two views to make a market, John. Now, of course, the market we have seen has been more in the ballpark of Mike Wilson being white so far this year, and that the S&P 500 is down more than 13%. Worst start to any year since 1970. For the NASDAQ 100, down more than 22%. Worst start to a year ever. It has been very volatile as well. The S&P 500 has moved in a daily range of at least 1% in 89% of the trading sessions so far in 2022. That is the wildest start to any year since 2008. So it begs the question, are we in for more, or is the worst over? Of course, we already ran through what Mike Wilson of Morgan Stanley says. Yes, he could see another 5% or so in this current bear market rally, but ultimately he thinks the index will trade close to 3,400 by the end of the second quarter earnings season in mid-August, which would imply about 18% downside from Friday's close. JP Morgan, on the other hand, one of those that's a little bit more bullish. The team there pointing potentially for massive month and quarter end rebalancing flows at the end of June. They say that could see about $250 billion moving into stocks coming from mutual funds, pension funds, as well as foreign investors, which could, they say, trigger a sustained rebound in equities. And it's worth noting, John, JP Morgan also made a similar call, expecting a significant bump in equities due to rebalancing at the end of the first quarter. And we did see that rally from mid-March through the end of the month, John.
Kelly, thank you. Speaking of the rally last week, that was sparked in many ways, in some ways, by President Bostic. These words from him: I have got a baseline view where, for me, I think a pause in September might make sense. That was last week. Governor Waller said this yesterday. I'm not taking 50 basis point hikes off the table until I see inflation coming down closer to our 2% target. Which world should we be living in, Governor Waller's or President Bostic's? Let's get into it with Tallbacker's Michael Purvis. Michael, your view on that, Governor Waller or President Bostic? Who are you listening to?
Look, I think the both and none, I guess, would be the short answer to that question, John. I mean, look, I think that the Fed is dealing with some incredibly complex issues facing the inflation story, the economic picture there. And I think they have to air out every side there, to kind of, in a way, to keep their credibility through this extraordinarily unusual cycle there. I'm not saying that's going to be enormously successful in preserving credibility, but I think it's to be expected. If you think about how unusual this cycle is, you're going to have accusations of policy mistake from both sides throughout, everything the Fed does going forwards here. So, if you have someone, net dovish coupled with someone net hawkish there, I think that's just to be expected here. We're just dealing with an enormous amount of uncertainty, through this, very unusual transition we're going through.
Well, Michael, which policy mistake do I want to trade? And that's the problem I have. A lot of people will criticize the Fed. It's a sport. I'm a part of it. I like to play it sometimes too. Forgive me for it. But when you start to talk about policy mistakes, I think you've got to be clear about which one. Is it a policy mistake because they smashed growth to get inflation down, or a policy mistake because they're too late and have to accept a higher level of inflation for a whole lot longer? Which one is it?
Well, look, I would say this. I think one of the themes that's really developing is the divergence from core to headline inflation here. And if the headline inflation is going to keep getting even more robust with oil prices, rising again today, that the more you're getting towards food and energy and supply chain specific issues, the higher the propensity for policy mistake is policy error is going to be, or put another way, the more you're sort of swatting mosquitoes with a sledgehammer there, right? So I think my view is that we may be they're probably going to be hiking pretty aggressively. I think the Eurodollar curve has it right, where you're probably going to see a relaxation next year. But then you may see, that may be temporary, and then they'll start hiking, yet again. How do you want to be positioned, in the bond market there is very hard, because I think, you're dealing with not just the Fed, but the ECB is getting very active right now, and that's going to put upward pressure on term premia and all that kind of stuff, and QE is just getting in gear. That's going to put upward pressure on term premia as well there. So it's hard to be sort of a strategic bond bull right now. But I also don't know how I'm sort of both not bullish, but not, super bearish on treasuries right now. I think they're going to be kind of range bound as these sort of forces collide. It's important to see that there's, the inflation story, John, is very, very complex. There's a lot of disinflationary forces occurring. At the same time, you're having resurgences of food and energy prices here too. So it's going to be a very, very complex story here. I think, the easier trade, I think, is what your prior guests were alluding to, which is that, the anti-ESG trade is the best energy hedge. You're, long materials, long energy. That's going to be better than buying tips, with this kind of, backdrop for the Treasury market and the Fed.
Well, energy is the story that's working out this morning anyway, and on the year too in a big way, close to 60% higher on the year on the S&P 500 energy names for that industry group, that sector. The energy story this morning up by 1.6%, the S&P down about 1%. If you're just tuning in, a lot of this coming off the back of the move we're seeing in the bond market by 9 or 10 basis points through the curve, up about 9 now on a 10-year to 282, on a 10-year, on a 2-year up about 6 basis points to, let's call it 254. Mike, I promised that I'd bring up the words of Mike Wilson again for you over at Morgan Stanley. Came out with a note this morning, just said upside's limited. I think we're all pretty familiar with the view of Mike Wilson now. He said this: it's difficult to construct a case for more than a bear market rally, which could carry another 5%. He went on to say inflation remains too high for the Fed's liking, and so whatever pivot investors might be hoping for will be too immaterial to change the downtrend. Do you agree with that, Mike?
Not necessarily, no. I mean, look, there's a lot of two-way volatility. We're at, last week we added 1 PE point onto the S&P 500. The week before we took off 1.5 points in a week, right? So you can get, you get up a couple hundred points on a stable bond market. You can get the equity risk premium, down to the points where you don't want to own it, right? It's a very fast-moving market here, and the valuation arguments change as quickly as the prices do. So but I would say this, so I'd actually...
Okay, traders, as you can see, we need to place stop loss for Bitcoin at 31,354. Okay, please place your stop at 31,354. Just right here. Okay, anything will happen, you will not lose. Actually, sorry, this is 1%. We will place stop, we will hold. Please cancel this order and please place your stop at, I'll tell you where, 31,671 minus 5%, 31,512. We will hold longer. This way, we will not lose anything at all, and we'll see what's going to happen with Bitcoin. If it will move lower, we will move to 1% profit in our advantage. Otherwise, we will, let's say, we will play this game, we will play this movement on Bitcoin a little bit longer. Okay, guys, stay with me. Follow my trades, and I'll speak to you later, guys. Stay safe.
Lower than U.S. inflation, right? I don't think a lot of people had that, on their playbooks, coming into COVID.
Hard to imagine also, Michael, this might be a year where the U.S. outgrows China, given the growth fears we have domestically here in the United States as well. Mike, I've got to run. It's awesome to catch up with you as always. Michael Purvis there of Toolback, and mentioning the China story. That's a factor behind the rally we see in crude. On Brent at 124, on WTI just short of 119. A factor behind what we're seeing in the equity market as well. When you just break down a sector composition this morning, where the performance is, energy equities up by 1.9% and up about 60 percentage points year to date on the S&P for that industry group. Elsewhere, the story in the bond market, yields higher, much higher by 10 basis points on a 10-year to 284, on 2s to 255. I promised we'd talk about China. We're going to do that next. Up next, China's daily COVID cases falling below 100 for the first time since early March.
We're probably still a bit cautious. I mean, it's good news, and we still think you will get to a living with COVID situation in China, but probably not right away.
That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja, belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're probably still a bit cautious. I mean, it's good news, and we still think you will get to a living with COVID situation in China, but probably not right away. And the big concern that we have is, even though the infection rates are falling, they have been falling, that should permit a reduction in some of the restrictions. If you look, however, at the vaccination rates, they're still pretty low.
So what we're hearing from China is that their daily virus cases are falling below 100 for the first time since early March. Beijing loosening COVID restrictions on mobility, allowing some workers to return to their offices and shopping centres to reopen too. Mike McKee across the story. Mike, an important development for the global economy in the last few weeks.
an important development, but we're not sure how good it's going to be because, as was just pointed out, the Chinese have inferior vaccines and they still have COVID cases running around the country. Up in the Northeast now, there are talk of some lockdowns. But as you can see, the case rate overall reported below 100 now has come down. But think about what's in that white space there. That is lost economic activity for the Chinese. And while they are starting to reopen, we're seeing it happen very slowly in Shanghai. A lot of factories still haven't reopened there. And you can see that in the slight improvement in the PMI numbers from China, but still negative, still showing contraction for manufacturing, non-manufacturing, and the composite. So the Chinese still have a ways to go, and their economy is still shrinking. Now, the most interesting chart I saw about the whole thing over the last couple of days, John, is this one. It shows liquidity in the Chinese markets, basically. And what it's showing you is interest rates so low because nobody wants to borrow. And if companies are not borrowing, the economic engine isn't revving up. And at this point, China still has problems ahead.
And yet what we see on Wall Street are people lining up to pitch the buy China story. Two quotes for you, one from Amundi, who say, to be underweight Chinese equities today is risky. It's better to be overweight because medium term we think there's value. Mislav Matejka at JP Morgan put out a note in the last couple of days. We think the China outlook has improved, given poor prior performance, policy turn, key risks moving into the open and potentially better tariff news flow. We're now overweight EM versus DM, including China for that matter. Now, Mike, that's the Wall Street call. That's the market call. Can you give me the economic call right now? Because I've seen numbers, GDP forecasts for this year in China with a 3 handle. Where's the team at here at Bloomberg?
They're close to 3, but I think a little bit below that on the 2s, because at this point, so much damage has been done mathematically, it's going to be hard for them to get much higher. Plus, the risk remains that they still have to do some more lockdowns. Beijing isn't locked down, but restrictions are very severe there in terms of moving around. And so at this point, the Chinese economy still faces a lot of tests ahead.
Mike, before you run on China, just a couple more on the United States. We talked about this through this morning. You and I have done this offline as well. This meeting later on this afternoon between Chairman Powell, Secretary Yellen, and the President of the United States, Joe Biden. Your thoughts on that?
Well, some people are suggesting that this is a change in perspective or a switch in views by the White House. It's a switch in views by the political part of the White House that wants people to know the president is on top of this. But it isn't much can be done. Jay Powell is going to stay out of any kind of fiscal decision. He makes that clear every time he speaks. And the president has already said he's not going to talk about monetary policy. So where did they go from here? The Fed's told us what it's going to do. The president's told us what he's going to do. So, yes, they're both focused on it.
A photo opportunity a little bit later this afternoon at 1:15 Eastern Time. Mike, thank you, as always, buddy. Mike McKee there, breaking down the global economy for you and the equity market. If you are just tuning in, about 20 minutes into the session, we're down a little more than 1%. Top of the pile's energy equities up by 1.8%. Bottom of the pile, real estate, healthcare down by 2 percentage points. Off the back of some of this, fueling the gains we see in energy is the crude story, again up by 3.3% to about 119 on WTI, and Brent crude 124, traveling higher by about 2 percentage points as driving season gets underway stateside. That's the US story. US listed Chinese stocks rebounding too. We could be on track to wipe out some monthly losses here. Let's get back to Abby for more. Hey, Abby.
Hey, John. Well, it's really pretty incredible because as we do have U.S. stocks down more than 1%, as you were just mentioning, China-listed stocks as a group up more than 4%. It has everything to do with that China optimism that you and Mike were just talking about, the possibility, the hope that their economy will improve, perhaps move back into expansion. So you can see the likes of Alibaba, JD.com, Pinduoduo, NIO, all up more than 4% on the possibility, again, that maybe the lockdowns come to an end. Interestingly, Alibaba last week put up a great quarter because of the lockdowns and having consumers locked in and shopping, apparently. As for the Hang Seng, we do see that index in Hong Kong is back above its 50-day moving average, suggesting the buyers are interested, that there could be some relief rally here. But that's happened a few times over the last year. So will it last? Now, the technicals, the longer-term technicals for the Hang Seng may be constructive. Less so, though, for that NASDAQ Golden Dragon Index. over the last year, John, it's just incredible. Down 53% from a peak to trough point, down 76%. The CSI down 23%. Emerging markets overall, because of that strong influence from China, down 22%. You can see relative to the developed world, down 6%. So there's a big divergence between that weakness in China and the world. But nonetheless, there are some folks really buying not just that dip, but catch a falling knife. Will it work? I guess we'll find out with some time.
Brutal over the last year. Abby, thank you. And just to give you the year-to-date moves on the NASDAQ, we've trimmed them over the last week to negative 23% on the S&P 500 year-to-date. Not off the highs, but year-to-date, down by 13.68% on the session, down about 1 full percentage point. Triggering the move higher last week, just a piece of that was President Bostic of the Atlanta Fed talking up a pause at the Federal Reserve, maybe perhaps in September. They stop hiking, reassess, look around, whatever you want to say. Governor Waller yesterday pouring cold water over that argument, and Bank of America publishing just moments ago saying this: after hiking 50 basis points to the next two meetings, the Fed is much more likely to shift to 25 basis point hikes than to do nothing. They go on to say by September, the funds rate will likely be 1.75 to 2%. In our view, their view, that is well below any reasonable estimate of neutral. The words of B of A a little bit earlier this morning. So equities up on the Bostic story last week, equities down on the Waller story this morning. Just a small piece of that anyway. We're down 1.1% on the S&P 500. Up next, your trading diary for the week ahead. From New York, this is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
"25 minutes into the session, equities down, yields higher." Here's the stock story, down by 1% on the S&P. On the NASDAQ, off by 1.1%. If you take a look at the bond market, 2s, 10s and 30s, yields higher. Off the back of Governor Waller unwinding some of the move we saw from President Bostic last week. Waller talking up higher rates through this year as they try and get inflation down to 2%. Yields higher by 10 or 11 basis points on a 10-year to 284. That's the price action. Here's your trading diary. Coming up, U.S. consumer confidence numbers at the top of the hour. The big event coming later this afternoon. President Biden hosting Fed Chair Jay Powell and Secretary Janet Yellen of the Treasury at 1:15 from the Oval Office. More Fed speak and a lot more data tomorrow. You'll hear from Bullard of Williams on Wednesday, plus some global PMIs, including China too. And I think an ISM and some JOLTS data too in the mix going into claims on Thursday. And then rounding out the week with the big one. It's the US payrolls report this coming Friday. From New York City, good to be back in a seat with you. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
now they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Okay, guys, as you can see, position closed on Bitcoin. We made £500 today in about 3 hours. Good trade. Well done, guys. And for our strategy, please go to companyeye.co.uk. Otherwise, stay with me, follow my trades, and if I will see something profitable will come up on screen that will show you right now, I'll place a trade, you copy, and you will make a profit. Okay, stay safe, and I'll speak to you later.
That took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of two suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in.
It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent
and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept.